Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, 87% of US stocks held by top 10%, fueling a K-shaped economy propping up global luxury. We'll analyse why this extreme wealth concentration creates a fragile economic pillar and how a US asset price drop could trigger a global downturn. Second, UK banks exploit a £2 billion tax loophole from misconduct, threatening fiscal stability and the pound. So we'll discuss why the government is allowing this loophole and what it means for the UK's borrowing costs and London's financial reputation. Third, UK's high visa fees deter top scientists, sparking brain drain fears that threaten its economic future. We'll explore how this policy paradox could reshape the UK's global competitiveness and erode its high-value university export sector. Let's start with a single statistic that might just change your entire perspective on this. The top 10% of Americans now own over 87% of the stock market. The bottom half of the country, they own just 1%. So the thing is, economists talk about a wealth effect, the idea that when the stock market goes up, people feel richer and spend more, boosting the whole economy. But if only a tiny fraction of people own most of the stocks, that wealth effect becomes incredibly narrow. The gains don't trickle down. This creates a misleading signal for policymakers who might think the economy is stronger for the average person than it actually is. This is the reality of the K-shaped economy. While the S&P 500 has soared nearly 86% in 5 years, creating record wealth at the top, a different story is unfolding on the ground. In New York, a new luxury department store called Printemps serves champagne to shoppers browsing $600 coats and $1,400 boots. Across the street, hundreds line up for free food. And this isn't just a one-off observation. Major CEOs are sounding the alarm. The head of Delta says growth is coming from premium customers buying first-class tickets. Coca-Cola's revenue is being driven by its high-end drinks. This is a deliberate strategy across many industries called premiumization, focusing on higher-priced, higher-quality products for the wealthy. Something that's become crucial, almost under the radar, is how this trend impacts the global market. For example, with demand slowing in China, the resilient spending of high-end American consumers, fueled by their asset gains, is what's providing a critical offset and propping up the entire global luxury sector right now. This is where the situation takes a more complex turn. The CEO of McDonald's reports that low and middle-income customers are feeling so much pressure that, quote, people are actually skipping breakfast. This really highlights the uneven burden of inflation. You know, the official inflation number, the CPI, is just an average. For lower income households who spend a much larger chunk of their budget on necessities like food, gas, and rent, their felt inflation is actually much higher than the headline number suggests. That's why they're forced to make painful cuts, like skipping meals. And the data from Bank of America really drives this home. Spending for high income households grew nearly 4 times faster than for low income households this year. In New York City, the poverty rate has hit 25%, almost double the national average. Even credit scores are splitting. Now, get this. The number of both super prime and subprime borrowers is rising at the same time. Super prime refers to people with the best credit scores, while subprime refers to those with the lowest. Normally, you see one group grow while the other shrinks. Seeing both grow simultaneously means the middle is hollowing out. It's a real-time signal of rising financial fragility. It all adds up to a picture of two entirely separate economies. As economist Peter Atwater, who coined the term, described it, it's a world where, quote, those at the top appear to have everything, not only everything, but have it in oversupply. Meanwhile, those at the bottom feel like they're experiencing scarcity in everything that matters. Looking ahead, what are the key indicators to watch? It's crucial to look past the headline numbers. Keep an eye on the earnings reports of companies like Dollar General versus luxury brands like LVMH. Their diverging fortunes are a real-time gauge of this split. Also, watch consumer credit delinquency rates. If we see a rise in defaults, especially among subprime borrowers, it could be an early warning of wider economic stress. The risk here is that if US asset prices were to fall, it could remove the one pillar supporting high-end spending, potentially creating a synchronized global downturn. Speaking of fragility in the system, another major economy is wrestling with its own financial vulnerabilities, this time stemming from the banking sector. The most unexpected news out of the UK today has to be this. Major banks are on track to exploit a £2 billion tax loophole, and it's directly linked to their own misconduct. And this isn't just about banks being clever, it's actually a policy choice by the UK government. This socialises the cost of private sector misconduct, making taxpayers foot the bill. After all, this could worsen the UK's budget deficit and raise its future borrowing costs. The issue stems from the £11 billion motor finance scandal, where borrowers were overcharged on car loans. Banks like Barclays, Santander, UK and Lloyds are now facing massive compensation payouts. For the average person, the fallout is quite direct. This massive compensation bill will almost certainly force a structural tightening in the UK motor finance market. In simple terms, getting a car loan is about to get more expensive and harder to get, which could become a major headwind for the UK's auto sector. But the real turning point is a rule from 2015 that was supposed to prevent exactly this. It was designed to stop banks from deducting these kinds of payouts from their taxes. The situation presents a fascinating duality. On one side, you have the rules, but on the other, banks are using what's called regulatory arbitrage. Because their motor finance arms are technically considered non-bank entities, they can sidestep the rule. Interestingly enough, this suggests that the capital buffers of UK banks might be more vulnerable to these kinds of conduct-related costs than regulators assume, potentially masking financial fragility that could surface in a downturn. The UK's Office for Budget Responsibility has confirmed this loophole means taxpayers will lose out on £2 billion in corporation tax. This is a big deal because the UK's public finances are already under pressure, and this loss just adds to it, which could eventually weigh on the British pound. The situation is sparking outrage. Bobby Dean, a Liberal Democrat MP on the Treasury Committee, says it's not right that taxpayers are set to lose out on billions. He is now urging the government to intervene and close the loophole. The government's handling of this scandal is really a major test of its regulatory identity after Brexit. Allowing this loophole could signal a divergence from stricter norms in the EU and US, affecting London's long-term reputation as a stable financial centre. However, if you zoom out, you'll see another layer of strategy at play. This credit shock could inadvertently weaken incumbent automakers like Ford and Honda. This disruption could create a unique market entry opportunity for new players, like Chinese EV brands. Data shows brands like BYD have already seen their UK market share surge, and a disruption in the traditional finance to sales channel could open the door even wider for them. So what are the key things to keep an eye on? First, the government's official decision on closing this loophole. Second, the Bank of England's credit conditions survey for signs of tightening in auto loans. And finally, monthly car sales data in the UK. This will be the clearest indicator of whether this credit squeeze is creating a real opening for new brands to capture market share. We were just talking about the UK's global competitiveness in finance and auto manufacturing. Well, let's shift our focus to another critical pillar of its economy, its world-leading science and research sector, which is now facing its own crisis. The story begins with a decision that led one of Britain's most decorated scientists to say the UK government is shooting itself in the foot. That incendiary quote comes from Nobel Prize winner Professor Sir Paul Nurse, and he's warning the country's entire research future is now at risk. The core of the conflict is a visa system with fees so high, it's actively deterring the world's top early career scientists. Believe it or not, we are in the middle of a geopolitical talent war, and the international mobility of top researchers is a critical leading indicator of a nation's future economic power. While the UK puts up financial walls, Sir Paul warns that rivals like China and Singapore are rolling out the red carpet. For the most elite researchers, this is a zero-sum game. The UK's loss is a direct gain for its strategic rivals, which could shift the global balance of technological power. Sir Paul bluntly asks, why do we put hurdles in the way of the people that are actually going to drive our economy? It makes zero sense. To put these hurdles into perspective, a mandatory health surcharge was recently increased by 66%. This means a top scientist arriving with a family on a 5-year visa could face upfront government fees of over £20,000. This decision brings the benefit of revenue from the fee, but comes with the inherent risk of acting as a hidden tax that directly undermines the UK's own public investment in science. Now, get this. The number at the heart of the debate is shockingly small. According to the UK's own Home Office, the total number of science job visas issued in the last quarter was just 323 people. So we're talking about a few hundred people, but their impact is huge. What really brought this to a head is the threat of a long-term drag on productivity growth. A dynamic R&D sector filled with top global minds creates innovation spillovers that boost the entire economy. A shortage of this talent could erode the UK's competitiveness in high-value industries like biotech and AI. And here's where it gets interesting. A policy expert from a think tank that actually advocates for times lower times net migration largely agrees with the scientists' concerns, noting that even if the number of incoming scientists doubled, it wouldn't make a huge difference to the overall migration numbers. This is crucial because top research talent is what secures grants and maintains global university rankings. A drop in rankings could create what experts call a doom loop for UK universities, where less talent leads to less funding, which in turn makes it harder to attract more talent. So, what's the bottom line? The UK is facing a high-stakes economic paradox. Its global leadership in science is being jeopardized over a policy that impacts a few hundred people per quarter. The key focal point to watch will be the UK's visa application data in the coming quarters. Any continued decline could put further downward pressure on the British pound as investors worry about the UK's long-term innovation capacity.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.